Good morning. I'm James Lopez, President at HomeFi Corporation, and this is today's mortgage and real estate market update. Hope you had a great day yesterday. We're going to dive right in today talking about the Fed. And the past couple of days, we've been kind of focusing more upon the market and kind of the mortgage bonds and rates and things like that, specifically because of what's going on this week with the Fed. The Fed has a big meeting this week, as we've talked about. And we haven't talked as much about the real estate data. And the main reason why is because what the Fed does this week and the meetings and the press conferences and all that kind of stuff, it all affects all of the market, including the real estate market. And so that's why we're kind of putting some emphasis right now on the Fed and what's going on. So all that said, let's talk about it real quick. All right, so the Fed has been in tightening mode since the beginning of 2022. And there's been multiple levels of concern that have been raised throughout the year so far. Now, the more concern there is, the faster removal of accommodation in the market there is, i.e. rate hikes on the Fed fund rate and tapering of the or normalization of the Fed balance sheet. Now, the Fed has announced in an earlier meeting where they want to try to get to as far as normalization of the balance sheet goes, their cruising altitude, so to speak. And that what that means is how much every month they want to try to draw down the balance sheet. So they've already announced that cruising altitude. It's about $100 billion a month that they want to pull off of that almost $9 trillion balance sheet. All right, but they didn't announce how quickly they want to get there. They didn't announce how fast they want to get to that $95 billion a month drawdown. So this meeting this week, the Fed FOMC meeting starts today. It'll end tomorrow. It'll wrap up with a press conference. And while the general market has already priced into the market what they expect to be is a 50 basis point rate hike for the Fed fund rate, what the Fed, again, hasn't announced is how quickly they're going to get to that drawdown level. And so that's produced a little bit of volatility in the market. Yesterday we saw the market, mortgage bonds drop, but the worst levels of the day yesterday were at about 50 basis points off. They regained most of that and ended about 23 basis points lower than they were on Friday. The 10-year yield kind of jumped yesterday pretty high, got all the way up to 3% yield, the first time that it's been that high since Q3 of 2018, and backed back off of that ceiling a little bit. And so we're just seeing some volatility in the market. Today, so far, mortgage bonds are up about 11 basis points at the time of recording. The 10-year yield is off about 6 basis points. It's trading at about 2.93. And what that really means for mortgage interest rates today is that interest rates are probably going to open about where they left off yesterday. And the reason why is because there's a lot of upward room to go for the 10-year yield. So there's upward risk on the 10-year yield, and there's a lot of downward risk on the mortgage bond. So if the market for any reason begins to break one way or the other, it's going to break fast, and it's got a lot of room to go before it hits its next technical levels. And so we could see some repricing for the worse throughout the day today, and it could come very quickly for whatever reason. Now, time will tell, as the news comes out from the Fed meeting and as things happen throughout the week. There's other news that's coming out this week that could be market movers as well. We'll continue to keep you updated. But again, this week, all eyes are on the Fed, what the Fed is doing as far as economic policy for the entire country. And like I said, that reaches out and that touches every facet of our economy. And so it's important to understand what they're doing, why they're doing it, and how they're doing it, and how that affects the rest of the market as a whole. Going back to the interest rate hikes, like we've discussed, the Fed fund rate interest rate hikes are meant to help combat inflation, which is good for mortgage bonds, which we should begin to eventually see mortgage bonds take a turn and start to go back up, which should mean that mortgage interest rates should level off and start to come back down. Again, time will tell, and we'll see what happens throughout the coming weeks and months, but that's what we're looking forward to happening. If you have any questions about the Fed or the FOMC or how they meet or when they meet or anything like that, leave a comment on this video. Make sure you like and subscribe to the YouTube channel, but also leave a comment. We'd love to have a discussion with you and do some research and help you understand any questions that you may have about the Fed and how it works in its monetary policy and everything. Be sure to subscribe again to our YouTube channel. Head over to our Facebook page and like our Facebook page there. We also post some information exclusively over on our Facebook page. That's all that we have for today. I hope that you have a wonderful day, and we will see you tomorrow.